Well, let's talk about the European central banks, not
Swiss
only the ECB.
Yeah, look at this. Swiss. Now we have an ECB announcement coming out in 30 minutes. Where are we? 30 minutes. Thank you. And a press conference afterwards. Swiss surprised. They were supposed to cut 25 basis points. They cut 50 basis points. You're getting a little bit of a sense. Am I right? They cut 50 or?
Yeah, no, you're right. So in the last several months, they've cut from. They only got as high as 180.
Remember, during the heart of the financial crisis, Swiss short-term rates were negative 2%.
Well, but I want to say, did they not get up to 3% at some point in like 21 or 22? And then cut and hike. Maybe they only got up to 180. This is obviously only the last year's worth of data. Either way, they didn't get as high.
Nowhere near as high as the U.S. rates. But remember, they were coming, as weird as it was, and none of us thought this could happen until it did, but they were running negative interest rates to basically use it as a tool to keep their currency in check.
Mm-hmm. And so while they didn't get up to 4%, like the ECB or Bank of Canada or whatever, or 5% like the Bank of England or the U.S. They were hiking, and now it's not only been cuts, Pete, but so they were expected to get down to 75 bips, which would be under 1%. They were already at 1%, under 1% for a major economy, really the first to go that low, and they cut all the way down to 50 bips. I mean, at this rate, they might be at zero or negative first quarter of next year. Like this is a pretty aggressive line, and you have dollar rallying against the Swiss franc. Obviously, rallying here on the news came back a little bit, but continuing that rally now. And I'll bring up the daily chart because I don't think this dollar is yet at highs versus this Swiss franc. Which I mean, we're going to get into the euro in a second, and you were telling me a little bit before we got on. Man, it feels like it's one of those times, and maybe this is the time to go against what I'm about to say. I can't think of a bullish story or reason or anything for these European currencies. I can't think of anything.
Nor do I think their central banks think the same thing. And all this talk of tariffs and stress, the quickest way to get around that is just mark your currency down. Mm-hmm. You're going to put a tax on our goods. We're just going to make them cheaper. So we're going to mark the currency down. Now, what prevents everybody from marking their currency down as cheap as possible? And that's basically going into a price war with currency. Marking your currency down to a certain point will have an effect on inflation in your local economy. So you're mindful that if you depreciate your currency too much, you will end up stoking inflation. So there is a trade-off to be had. But in the short run, it seems, they're willing to take an aggressive stance to keep their economic engine moving. And one of the tools, again, what tools do they have? They can change rates. And by changing rates, they can have an impact on the currency. We talk about that. Rates impact the currency. 1-to-1, every single time the same way? No. But there is an impact. And as much as the rates themselves, the trajectory of the rates. What is the trajectory? And I didn't read the SNB, Swiss National Bank, press release afterwards, but I've got to imagine that it is that I'm guessing without saying it, is that this was an aggressive cut that was needed and more may be on the way. Mm-hmm. So, sometimes when they look at, they expected 2 25-point cuts in the next 2 meetings. Well, they got all 50 right away. Sometimes that's like, okay, they're done. But if the talk was that, we moved a little bit more aggressively and we'll reevaluate and move again if needed, that says the trajectory is probably still lower, and you'll see a tough time for that currency to rally. If that currency falls, that means the dollar rallies against it, which is what we're seeing play through right now.
In a scenario like this, where you have the potential to create another dollar yen type of trade here with this dollar Swiss.
And remember, Swiss rates are now under yen rates.
Wow, is that right?
Yeah.
Wow, that's crazy. Maybe we'll look at yen Swissy in a second.
Yeah.
Or, anyways,
which is great because those are traditionally, doesn't always hold, but those are the safe haven currencies. So it's an interesting byplay between the two of them.
so when you say stuff like everything that you just went through, where it's like the central banks and the economists and everybody in charge in Switzerland, or in the euro area, which we'll get to in a second, because they have a rate decision coming up where they're likely to cut. They're not necessarily worried about their currency being devalued. Devalued currency sounds like a bad thing to me.
Sure.
It sounds like, when you hear about everything that's gone on in Japan the last couple of years, it sounds like a bad thing. But is it right that the smart people, I don't want to say smart, but the people that have done well in Japan on the ground the last few years with such low interest rates have been invested in the Nikkei or hard assets like gold or whatever, because their yen has been devalued on the ground there in Japan? And so is it a negative thing necessarily, or is it just a thing and a part of doing business in the potential Trump U.S. bigger tariffs landscape?
Right.
Because it sounds like a bad thing, and it's one of those things that I think people read online, like the headlines will be, Switzerland devalues its currency, and that sounds really bad. Like it sounds like their economy is crashing and they're screwed. But is it more nuanced?
Now,
than
did
that?
they devalue their currency? No. They changed their interest rates. It had a knock-on effect to the currency. Now, usually when they talk about devalued currency, it's a peg currency. And are there still peg currencies? Yeah, the Chinese onshore renminbi is a managed currency. CNY that's traded offshore is what floats. So there is a knock-on effect to changing your interest rates that plays through your currency. So you could say their lowered rates have triggered a lower currency environment. Now, the Japanese it's a unique circumstance. The Japanese have had these low rates for 25 years, and they've argued that the low rates they've got a unique set of challenges. They've got their population isn't growing. Their population demographics are aging very quickly. And those aging people are savers, not spenders. And so they're having a difficult way stimulating consumption. So they're trying to get their goods to be consumed by the globe. So it's different dynamics at different places.
Sure.
Central bank has a different set of circumstances. Each one of them has a different set of circumstances they're dealing with. So looking at, is a negative currency or is a lower currency a bad thing? It depends. Again, cheaper currency, if you think about it, if you were in Japan and the yen was, at 100 to 1, we know it's 150 to 1. At 150 to 1, everything you want to buy that isn't made in Japan, whether it's something from the U.S. or everything, is 50% more expensive.
Yeah.
That's a lot. So what is your likely behavior? You're going to buy domestic goods that aren't necessarily priced as expensive as foreign goods. So does it stimulate? Is it an attempt for these savers to stimulate them to go and spend? Well, what they've done is, you're right, they've invested in. They haven't spent the money. They've just moved out of yield-bearing assets
0%
to equities,
equities
and ETFs. Absolutely.
And so the only reason I raised that point is because it seems like there's a lot more room that stuff like this could run in the dollar's favor and against some of these other currencies, because I don't want to make it seem like, Switzerland dropped its rates more than the SMB cut rates more than expected, but other parts of Switzerland, other people that are part of the Swiss government or make regulations or whatever are going to try to pick this franc up and do stuff to spur it on, because it's not competitive like that. They're not necessarily looking at this and being like, oh man, we need to get the dollar franc back under 85 cents because like it's a competition like the equity market,
Right.
and it's not like that. And the reason I raised these points is because we are going into this ECB meeting. Eurodollar is right there at 105, and you made this remark to me before we went in. You're looking at parity, and you might think, oh, the European central bankers don't want anything to do with parity. But in this new environment of higher tariffs, is it something that maybe they not necessarily want, but would be fine with?
Is Canada getting 25% tariffs? Is Mexico getting 25% tariffs? I don't know. Is this part of a very large negotiation? And is changing your interest rates a response? Is a parry back in that negotiation with the implicit delivery of, yeah, you can put up tariffs and we'll mark down our currency and negate the value of that tariff in terms of our competitiveness to export goods. This is part of the back and forth. Countries just don't have to take it. There are things they can do and I think these aggressive rate cuts are part of that response to this negotiation back and forth. Are they saying that we did this to respond to you? No, but smart people can read between the lines. So you're absolutely, I think let's take it back to what this means for traders and get away from the macro part of it. What it means is that currency now will be a tool of negotiation, which means for us, that's good as traders. It means we'll get a little bit more volatility. There'll be a little bit more interest and uncertainty. As traders, we want volatility. We want uncertainty because that gives us range, and range gives us opportunity to get in and out. Whether I think, again, in 30 days, we'll be able to clearly say that 105 was really cheap or really rich. Now, do I know which one it is? No, but I have opinions, and everybody else does too. If you look at it, it was 112 30 days ago. This is really cheap. That's a 6.5% markdown in 30 days. That's a 70% devaluation on a yearly basis. That's a lot of markdown in currency. But again, if they're aggressive and the tone out of them is it's a race to the bottom now in terms of yields, par comes into question really quickly. Yeah. I'm not saying we're going there, but what I'm saying is, as a trader, I want the opportunity to be able to trade both sides of the market. And this lets me, I'm not always a contrarian. I'm not always looking at things that are cheap. I'm looking at things that give me elasticity to trade. And this is a perfect example of it.
Exactly.
So
right.
This will be an interesting, especially watched meeting in 20 minutes. And as much the conversation afterwards from Christine Lagarde, I think 45 minutes after that. Am I right?
Yes, the meeting is in about 20 minutes, and the press conference is
half an hour
30 minutes after that.
Okay, so we should definitely get some good moves out of that. Then we've got, in between those two timeframes, we got PPI coming out in the U.S., which will be some follow-on inflation numbers, which, again, there was a case the inflation numbers came out exactly as expected. Mm-hmm. Market didn't do much. Actually, the dollar got a little bit, which tells you, like, can you get numbers that don't mean anything, although yields did steepen in the U.S. We saw 10-year and 30-year yields, especially trade higher. Bonds and notes trade lower on it.
In the short term, not so much, yeah.
Right. And did that have a little probably lift to the dollar? Sure. So keep an eye on notes and bonds, see what yields do. That will also have a knock-on effect. We know this is all interest rates. They're not changing their currency. The euro announcement in 20 minutes is not about changing their currency. It's changing what their overnight deposit rate is. So they don't control what their 10-year bond is.
But you're seeing a lot more volatility in their currency based on on what they're doing.
Absolutely. And that's what we want as traders. So stay focused on what we can do as traders for takeaways. And again, we'll take a look at, yen Swiss. Tomorrow, we're running out of time today. But those two flight top haven quality currencies that are now yielding at their short-term rates are at 1%. That'll be an interesting pair to look at. And what's great about FX is go try to build that anywhere else. There's no stock, there's no ETF that you can trade that pair on. Can you build them with futures? It's expensive in terms of you got to margin both sides, and you never build the pair you want. So this is where spot FX, you want the right product to do the job, and this is where you can find it. Thanks for tuning in. We'll see you back here tomorrow on Forex Focus.